It's Friday. Welcome to Modern Investing Techniques, episode 27. It's April 24th, 2026, and I'm Patrick in Vancouver. Friday wrap up. Let's see how the week played out and what to watch next. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The Federal Reserve faces a stagflation trap as the Hormuz closure removes 20% of global oil supply, with no painless policy option available. Markets traded modestly lower today, with the S&P 500 closing at 7,108, down 0.4%. The NASDAQ Composite finished at 24,438, down 0.9%. The TSX Composite was at 33,913, down 0.1%. Geopolitical developments around Iran continue to influence commodity and inflation expectations. About 14 days ago, we picked SSRM on a balance sheet recapitalization and insider buying thesis. It closed down 4.21%. This is a clear example of strong company fundamentals losing out to overriding macro forces. Are we beating the NASDAQ this week? Our simulated portfolio trailed once again. Our portfolio stands at year-to-date minus 0.52% versus the NASDAQ, up 5.18% for an alpha of minus 5.70%. Since inception, it is minus 0.52% versus 9.23% for an alpha of minus 9.75%. We need better alpha generation in the weeks ahead. When macro regimes shift this violently, static portfolios get punished. That is exactly why we are dedicating today's strategy spotlight to regime-based hedging. Regime-based hedging is an allocation approach that adjusts portfolio exposures according to the prevailing macroeconomic regime rather than following static benchmarks. In a stagflation environment of rising inflation combined with slowing growth, traditional long-duration bonds and many equities become vulnerable. Certain real assets tend to outperform in those conditions. Today's conditions make this relevant because the closure of the Strait of Hormuz has removed approximately 20% of global oil supply. This is accelerating core inflation and recreating the impossible trade the Fed faced in the 1970s. Raising rates would worsen unemployment and growth, while cutting rates would likely send inflation higher. Historical parallels show severe drawdowns, with the S&P 500 falling 48% in real terms from 1973 to 1975. Inflation reached 12.3% during that period, and similar dynamics played out in 1978 to 1980. To implement this, you can screen for exchange-traded funds with proven performance in high inflation, low growth periods. Focus on energy, broad commodities, and tips while avoiding long-duration fixed income. You should also avoid overexposure to private credit that cannot easily refinance at higher rates. Platforms like Wealthsimple or Interactive Brokers allow easy exchange-traded fund rotation with low commissions. Rebalance when inflation metrics or oil supply data shift the regime probability. This strategy worked best in the 1970s inflationary decade, but carries risks including high volatility in commodities. There is also potential opportunity cost if inflation moderates faster than expected. The key discipline is treating it as probabilistic regime allocation rather than a permanent tilt. With these regime risks front and center, we are putting capital to work in a sector directly benefiting from the commodity dislocation. Here is today's practice investment. This is a simulated trade for educational purposes only, with no real money involved. This is not financial advice. For our weekly hold, we are selecting TECK, tech resources listed on both the TSX and NYSE. The strategy is sector rotation into mining on positive earnings reaction amid commodity supply disruptions. The catalyst is an earnings beat combined with investor focus on sector rotation and commodity dynamics. The technical setup showed a positive price reaction to the earnings release. We will monitor whether it sustains above recent short-term moving averages with volume confirmation. On risk, we note that rising fuel costs could pressure margins going forward. Our maximum acceptable loss is capped at 6 to 7% with a predefined stop. The target is plus 2% to plus 6%. Confidence is medium because the earnings catalyst and sector rotation provide two aligned factors. But fuel cost risks create a clear uncertainty that prevents high conviction. This trade demonstrates how to evaluate company-specific results within a broader macro and sector context rather than in isolation. You should practice identifying when an earnings beat aligns with or conflicts with larger commodity or input cost trends. The exercise reinforces the value of written targets and stops, regardless of whether the position ultimately delivers alpha versus the NASDAQ. We will track this one all week and evaluate it next Friday. Before we get too excited about the new position, let us review what happened in yesterday's flash trade. It is a painful but instructive reminder. In the CLDX flash trade, we entered at 35.79 on the analyst upgrade and positive phase 3 data. We exited at 34.38 for a loss of 3.94%. That equals minus $39.40 on a $1,000 position. Even with a clear binary catalyst, the stock moved against us. Expectations were already priced in, and sector momentum was absent. This reinforces the critical process gap in data verification. Rule: always verify data availability from multiple providers before declaring a weekly hold closed. Two practical tools that could have helped us avoid that outcome are worth highlighting today. First is implied move from options pricing. This technique uses options prices specifically at the money straddles to quantify the percentage move Wall Street is pricing in ahead of earnings. When implied moves appear cheap relative to historical post-earnings volatility, it can signal asymmetric opportunity. It gives individual investors an edge by revealing when the market may be underestimating uncertainty. This allows better position sizing or volatility-based strategies. Intermediate options users on platforms like Interactive Brokers or Questrade can access this directly in the options chain 7 to 10 days before reports. No special subscription is required beyond standard broker tools. Second is insider transaction monitoring. Services that surface timely. Form 4 filings let you see when executives buy shares with their own capital. For example, Nike chief executive Elliott Hill purchased 23,660 shares. These transactions provide a data point on internal confidence, though they should never be used in isolation. The edge comes from piggybacking on information asymmetry while combining the signal with technical confirmation and valuation checks. Canadian investors can use free SECEDGAR searches or paid platforms like Unusual Whales for alerts. Always verify the size, timing, and whether the buyer has a history of well-timed purchases. While we are scanning for edges, here are 4 quick hits that caught our attention this morning. Tesla has now generated more than $20 billion in cumulative free cash flow. This highlights improving capital efficiency and cash generation power. Review existing EV and AI exposure and consider adding on a 5 to 8% pullback if the free cash flow trend remains the primary long-term driver. AMD's market capitalization climbed above $500 billion in after-hours trading for the first time. It came with a more than 6% gain. Rebalance any single-name semiconductor positions that now exceed 5% of total portfolio weight following the valuation expansion. SoftBank is seeking a $10 billion margin loan collateralized by its OpenAI shares. This is amid continued AI investment appetite. Audit personal margin usage and reduce leverage if AI-themed holdings represent more than 25% of your account. FIGR shares fell 9% despite reaching a $1 billion lending milestone. Broader sentiment weighed on crypto-linked equities. Avoid initiating new positions in blockchain-based fintech names until daily volatility drops below 4% and price stabilizes above recent lows. Looking at our overall simulated portfolio after 8 trades, the win rate sits at 38%, with 3 wins, 4 losses, and 1 break-even. Cumulative profit and loss is minus $41.56. Average return per trade is minus 0.38%. The best trade delivered plus 7.88%, while the worst was minus 7.49%. We are currently on a 1-loss streak. Our AI analysis is learning from these macro rotation patterns and adjusting the screening process accordingly. This remains a learning journey, and you can apply the same analytical discipline to your own portfolio decisions. Now, here is something that most retail investors get wrong, and it has cost money before the lesson sinks in. Imagine you allocated $50,000 to a private credit fund in 2024, seeking steady 8 to 10% yields with low volatility. Your quarterly statements show consistent returns and a stable net asset value, but behind the scenes, the fund is likely using mark-to-model valuations instead of observable market prices. This means losses from defaults can remain hidden for 1 to 2 quarters before appearing in reported numbers. Unlike publicly traded bonds that reprice daily, private loans are valued based on internal models. Current data shows a shadow default rate of 6.4%, while headline figures sit under 2%. One subsegment sits at 9.2%. 40% of borrowers are now generating negative free cash flow, up from 25% in 2021. Over $350 billion in debt matures in 2026 and 2027 at rates 2 to 4 percentage points higher than origination. Professionals always demand underlying loan-level data, vintage year performance breakdowns, and manager skin in the game metrics before committing capital. They also cap exposure to any single private credit manager at 5 to 10% of the overall portfolio. You should stress test defaults at 2 to 3 times headline figures and maintain strict liquidity buffers. The biggest misconception is believing the reported low volatility and steady net asset value reflect economic reality. Instead, always stress test private credit holdings by assuming default rates 2 to 3 times higher than the headline figures. Open your brokerage account, whether TFSA, RRSP, or non-registered, and locate your 3 largest holdings. For each, note the percentage of portfolio and whether it would benefit or suffer in a stagflation regime. Energy and commodities are positive, while long-duration bonds are negative. Decide on one specific reallocation you would make this week. If inflation data continues to surprise to the upside, it takes under 15 minutes. Before we wrap tomorrow, we will examine how to use options implied moves to position for potential volatility spikes in the commodity complex. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content, and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.